Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate gibberish. And today's report promises to be especially exciting. We're diving into Ramaco Resources' latest 10K filing, but before we do, let me just say after reading this thing, I'm pretty sure even their accountants need a decoder ring. The big headline is Ramaco. A coal company just wrapped up its financial year, and while they're still digging, the report shows some interesting trends and challenges under the surface. Now, before we get started, a quick disclaimer. This report contains what they call forward-looking statements, which is basically corporate speak for we think this might happen, but who knows, so keep that in mind as we go. We'll focus on hard facts, and I will try to explain what they mean. First things first, Ramaco stocks are listed on the Nasdaq under the symbols METC and MECB, and their senior notes are listed under METZ. As of February 28th, they've got about 44.4 million shares of Class A common stock and 9.6 million shares of Class B common stock floating around. If you want to dig deeper, you can find all their reports on their investor relations website or the SEC's website. Now let's move on to the interesting bits. One thing to keep an eye on, Ramaco expects some new laws and regulations that relate to the environment, health and safety, or even climate change. So it could make things tough for Ramaco or those who burn coal. If that happens, Ramaco might have to spend more money to stay in business. Now, how about we take a look at some numbers? As of June last year, the total value of Ramaco stock held by the public, not including big company insiders, was about $405 million. Ramaco is saying they can dig up 4 to 5 million tons of clean coal every year right now. They're hoping to bump that up to 7 million, but that depends on things like getting permits and throwing more money at it, and whether the market actually wants that much coal. Most of Ramaco's coal is sold on year-long contracts where the prices and amounts are fixed. This means if the price of coal rises, they cannot take advantage of it. Let's get to the report card. According to the report, 2 customers made up around 22% of their total revenue during 2024. If one of those customers disappears or buys less coal, that's not good. They managed to sell 4 million tons of coal during 2024, bringing in 666,3 million dons. What's interesting is that most of that money came from overseas, with 67% of revenue from exports. Ramaco's got some pretty big competitors, names like Alpha Metallurgical Resources and Peabody Energy. And just so you know, Ramaco is what they call an accelerated fella, not a big, well-known company, nor a small reporting business or an emerging growth company. It's somewhere in the middle. They've also checked the box saying their outside auditor gave the thumbs up on their internal controls. But the fun doesn't stop there. Later in the filing, they admit to finding a material weakness in their financial reporting. Alright, let's dive a bit deeper, and as always, if you want to read along, I will include a link in the description below. Here are some more potential problems. Some of Ramaco's mining projects aren't finished yet, so delays or cost increases could really hurt their business. Also, if Ramaco can't find the money they need or get good terms on loans, they might have to slow down their operations. Also, mining has a lot of environment regulation, which increase costs. If their assumptions about those liabilities are wrong, they could end up spending way more than they thought. Here is a fun fact: they're not obligated to keep paying dividends. If cash flow isn't great or they find a better use for the money, dividends could get cut. Some of the directors have other jobs, which could lead to a conflict of interest on which company to prioritize. Also, the way Ramaco's stock is set up with different classes could cause problems. The board might make decisions that help one class of stockholders but hurt another, which sounds like a headache waiting to happen. Those senior notes they've issued, they're unsecured, meaning if things go south, they're last in line to get paid. It seems like one of the risks that they have is indeed a reality. Back to that material weakness in internal control. The company admits their financial reporting system isn't perfect, which could shake investor confidence. To summarize, Ramaco has ambitious production goals, but there are risks, one of which is that not all mines are fully developed and that these projects may be delayed or become too expensive. Another factor is that most sales are not locked in with long-term contracts, which means they might not be able to sell coal for economic prices during a downturn. Also, just a reminder, their customer base is heavily reliant on the steel industry, so if steel demand drops, so will Ramaco's profits. One particularly nasty point is the structure of their debts. The senior notes are unsecured, and if something goes wrong, they're last in line to get paid. What about their assets? It seems they will focus on core properties and monetize these assets. Also, following years of delays, the Pennsylvania Department of Environmental Protection issued a denial of the Ram mine permit during 2023. So what's my take after all this digging? Ramaco definitely has potential with those metallurgical coal reserves, and their focus on low-cost production is smart. But there are many things that are difficult to control, such as volatility in coal prices, heavy debt, and weaknesses in financial reporting. They definitely need to shore up their internal controls and diversify their customer base. All in all, it seems like there are big gains to be made, but lots of risk involved to get there. Now, it's your turn. What do you think about Ramaco Resources? Leave your thoughts in the comments, and if you enjoyed decoding this corporate report with me, don't forget to hit that like button and subscribe for more.